Before you rush into Hyundai's IPO, let me ask you this. Are you really sure this is a good investment? Everyone's talking about it because it's the largest IPO India has ever seen. But here's the real question. Is this IPO hiding more risk than reward? Today, we're going to peel back the layers and reveal the unseen truths that no one else is talking about. Why Hyundai, the company that dominated Indian roads for decades, may not be the investment you think it is. Let's rewind to 1996. This is when Hyundai Motor India was established, marking the South Korean automaker's entry into the Indian market. The company launched the Santro in 1998, a car that became an instant hit among Indian consumers. Affordable, compact, and fuel-efficient, the Santro turned Hyundai into a household name almost overnight. Back in the late 90s and early 2000s, Hyundai's strategy of offering feature-packed, affordable cars worked wonders. It quickly became the second-largest car manufacturer in India, just behind Maruti Suzuki. Fast forward to the 2010s, Hyundai continued its winning streak by tapping into India's growing SUV market with models like the Creta. This mid-sized SUV became one of India's best-selling SUVs and helped solidify Hyundai's presence in the more premium car segments. From hatchbacks to SUVs, Hyundai was able to offer something for everyone, keeping it relevant across all vehicle categories. Fast forward to today. Hyundai may still hold a 17 to 18% market share in the four-wheeler segment, but the competition is fiercer than ever. Maruti Suzuki continues to dominate with an incredible 41% market share, and Indian automakers like Tata Motors and Mahindra are gaining ground. The question now is, does Hyundai's position today justify the 25,000 crore IPO they're about to launch? As we'll see, things aren't as simple as they were in the Santro days. In the early days, Hyundai was all about rapid expansion and creating a solid foothold in India. But let's compare that to their financials today. For the 9 months ending December 2023, Hyundai reported revenues of 53,298 crore. If you project this to the full year, it brings Hyundai's total revenue to around 71,164 crore, a noticeable improvement compared to last year's 61,436 crore. However, let's dig deeper. The profit after tax for the same period stands at 4,382 crore, which annualizes to about 5,143 crore. While these numbers look decent, they don't scream growth. Now here's a striking comparison. Hyundai's parent company is trading at a mere PE ratio of 5 in South Korea. So why is Hyundai expecting investors to pay a whopping PE ratio of 27 for its Indian IPO? That's a huge disconnect that raises red flags. Let's get real about this. When you invest, you don't want to pay a premium price for modest growth, right? Here's where the red flags appear. Tata Motors, the company that is leading the charge in India's rapidly growing electric vehicle (EV) market, trades at a PE ratio of just 10. Tata is not only growing rapidly, but it's also at the forefront of the electric vehicle revolution in India, controlling 75% of the EV market. That's right, Tata is growing at a far faster pace, but it's valued more conservatively. Ask yourself this: why is Hyundai asking you to pay more for a company that's growing slower and holds less market share than its competitors? That's the elephant in the room that no one else is talking about. Back when Hyundai launched the Santro, there was no real threat, just Maruti. Today, Hyundai faces multiple battles. Tata Motors and Mahindra are giving Hyundai a run for its money. Tata is leading in electric vehicles, and Mahindra, with its strong SUV lineup and plans for 7 new electric SUVs, is nearly neck and neck with Hyundai in terms of sales. But there's a new player coming into the game that could change everything: BYD. If you haven't heard of them, they're a Chinese electric vehicle giant that's been quietly making waves globally, and they're setting their sights on India. BYD's electric vehicles are not only technologically advanced, but they're also affordable, which gives them a massive edge. Hyundai's delayed entry into the Indian EV market, with its first electric SUV planned for 2025, puts it in a weaker position compared to both local players and international threats like BYD. Do you remember the LIC IPO? That IPO was hyped as a historic moment, but it didn't live up to expectations. It drained liquidity from the market and left investors with minimal returns. Hyundai's IPO, being even larger, could have a similar effect. Given the size, it's likely to have a similar impact, sucking liquidity out of the market and putting pressure on both the IPO and broader market performance. Moreover, SEBI's new liquidity rules tightening the market further make it unlikely that you'll see strong listing gains from this one. This isn't just a guess, it's a reality we've seen play out with other large IPOs. So, what would a prudent investor conclude? Hyundai's story in India is nothing short of impressive. They entered at the right time, captured the market with cars like the Santro and Creta, and built a strong brand. But today's landscape is different. With intense competition from Tata, Mahindra, and the looming threat of BYD, Hyundai is facing more challenges than ever. Its growth is steady, but not explosive, and the high valuation doesn't seem to reflect the risks. Ultimately, it's up to you to decide whether you want to take on the risk. The IPO may be historic in size, but that doesn't guarantee success. What do you think? I want to hear your opinions in the comments section. Are you still applying for Hyundai's IPO after hearing all this? If you found this analysis eye-opening, hit that like button and share this video with others who are considering investing in Hyundai's IPO. And don't forget to subscribe for more in-depth insights that dig deeper than the surface.